Our next guest warns half the market isn't a bubble, and high valuation stocks are a big reason why. Dan Suzuki is a Deputy Chief Investment Officer at Richard Bernstein Advisors. Dan, great to have you with us. When you say high valuation stocks, I'm guessing that you mean the ones that we were talking about versus a Clorox, which is a high valuation stock relative to itself.
Yeah, I guess, what we're referring to is, if you think about, the 11 sectors in the S&P now, about 3 of those sectors have heavy weights in kind of tech and tech-like stocks and innovation, growth, and disruption. And those 3 sectors are information technology, communication services, and consumer discretionary. Those 3 sectors alone make up about half of the market cap of the S&P 500. And I think in different ways, they're all sort of have been buoyed by this bubble that we think is present in markets today, even after this big correction. And so I think that, it's a big risk. And something we've been writing about is, where do you go for diversification if everybody's portfolio is heavily concentrated and everything out there is heavily correlated? If you want diversification in your portfolios, you actually have to proactively put that diversification into your portfolios by reducing your weights to those, just from a pure, prudent portfolio management perspective.
Last time we saw you was January 18th, I think, and then you said that you saw a NASDAQ 100 correction of 50% in the cards from its highs. And I'm wondering, are you still sticking with that?
Yeah, I mean, it wasn't super scientific, digging through the, asset values sort of analysis. But, if we're right, and technology and technology-related stocks are in a bubble, go back and look at the history of bubbles. They don't softly correct and then, they're off to the races 6 months later. You typically see a major correction, 50% or more, and typically it comes with an overshoot to whatever you think fair value is. And so that was all I was saying, is that, we are in the early stages of the unwinding of this bubble. And so there's probably a lot more downside to go.
Hey, Dan, it's Jeff Mills. So, question about sort of where to hide in all of this, right? I know you said you like cyclicals, financials specifically, and then staples potentially. So relative to cyclicals, financials, do you worry about what an economic slowdown might mean for that sector? And then in the same breath, we just talked about staples being expensive. Can you just walk me through kind of the call there?
Yeah, Jeff, you make a great point, and I completely agree. I think that, right now, the way we've been positioned in the portfolios is essentially a barbell between defensives and inflation beneficiaries. As we know, most of the inflation beneficiaries tend to come with a lot of cyclicality. So I think the move here is, the further profits continue to slow, the further that the economy continues to slow, you probably want to, switch the concentration of that barbell away from the inflation beneficiaries and toward more of the defensive names. And on the point of, defensives being expensive, if you go back and look at all of the bear markets, over the last, 20 or 30 years, look at the starting point valuations for defensive stocks. They are never cheap. Going into a bear market, if this is going to turn out to be a bear market, they're never cheap, and they still outperform. And that's part of that is because what are they cheap relative to? What are they expensive relative to? They're expensive relative to the rest of the market, where earnings estimates are probably too high.
Dan, good to see you. Thank you. Dan Suzuki.
Thanks for having me, guys.
Richard Bernstein Advisors. Pete Najarian, I'll go to you because I feel like your portfolio is probably the inverse of what Dan Suzuki is recommending, in that he says inflation.
No.
But what? No? Okay, what?
No, you'd actually be surprised. I mean, some of my longest holds that I've had are very defensive. When I'm looking at like a Coke and a Pepsi and some of those kind of names that I think a lot of people view as defensive. But on the other side of it, I've got a heck of a lot of energy, Mel. I am very exposed there. I've got a lot of financials. So, I'm sort of in that, but not for the same reasons. I just found myself into a lot of these stocks over time because I like the management, and a lot of these through you guys, because we've had the pitch stock thing going for so long. And, along the way, I've actually added stocks into my portfolio that I might not have looked at. But because of all the research that I was doing, some of these have become a mainstay of what I hold when I hold these stocks. So I've maybe got 45 stocks or so. And right now, I would say that I've got energy, I've got financials, and then I do have a lot of defensives as well.